Taylor Riggs in for Emily Chang. This is the best of Bloomberg Technology, where we bring you all of our top interviews from this week in tech. Coming up in the next hour, the tit for tat continues, and China and the U.S. announce face-to-face negotiations scheduled for October. This after a new batch of tariffs imposed by the U.S. What it all means for Apple. Settlement reached. Google will pay $170 million as part of an agreement with the FTC for violating children's privacy on YouTube. Critics say it's not enough. And Slack jawed. Slack shares plunge after the company's first earnings report since its trading debut. At issue, service problems and competition from Microsoft. This week, China and the U.S. announced that face-to-face negotiations aimed at ending their tariff war will be held in Washington next month. Skepticism on both sides for true progress remain high. This, of course, follows President Trump's 15% tariff that became a reality last Sunday, dragging Apple further into the trade war. Now, while its flagship iPhone is currently spared, some key products are not, namely Apple's AirPods, Apple Watch, HomePod, and iMac. D.A. Davidson senior research analyst Rishi Jaluria joined us to discuss on Tuesday before the latest round of talks were announced.
Look, Apple's, like you pointed out, is kind of the clear one. Any company that has manufacturing in China is there. But I think what's maybe potentially more interesting than that is that it's starting to kind of spill over into other industries that we had assumed were a little bit more resilient or a little bit more tariff-proof. And for an example of that one, Autodesk is an example of, an enterprise software company that's recurring. Everyone kind of thinks of that as being very defensive, very tariff-proof. But because it's an industrial software company, they're actually starting to see a softening outlook as a result of kind of the ongoing trade war. And now that, the tariffs have actually kicked in and are reality, not just a negotiating tactic, I think we're going to see a lot of that go through and have people look at individual companies and say, is this going to actually impact some of those second derivative plays, not necessarily the obvious ones like the Apples or the semiconductors?
What are those second derivative plays?
Yeah, so anything in my mind that's related to design and manufacturing would be that. So that would involve services, that would involve anyone who's doing outsourcing related to that. That would also involve, again, software companies like an Autodesk or Cadence or Ansys that have businesses in that sort of space that may not be obvious on first glance.
You mentioned individual companies, and I wonder if it's as simple as sell Qualcomm by Salesforce, or if there's something much more idiosyncratic within those companies that you need to look at, given the trade tensions that are going on.
I think your second point is absolutely correct. You have to be very, very specific about the individual companies itself, not just the sector, right? And that's why I use software as an example, because we know that it is thought of as being a lot more defensive, but it turns out within software there are some sort of cracks out there, right? I mean, if I were to ask you about Zoom video, for instance, off the top of your head, that wouldn't come to mind as being an obvious one impacted by this, but a lot of their R&D and product development comes out of China, and that's how they've been able to be so profitable. Now we have to wonder, do these sort of tariffs start to maybe chip away at that advantage that they have on the R&D side relative to other software companies? So it is very much a company specific, not necessarily sector by sector.
We have, though, been within this trade fight, let's call March 2018. We're 18 months in it. Have companies really been pressured on the margin side, on the bottom line? You mentioned maybe they'd cut back with R&D, but tech spending still feels strong.
Absolutely.
Are you seeing margin pressure show up yet, really?
Not really. I mean, tech spending and especially at the business level tends to be very, very strong. And outside of an actual macro event that impacts the economy and actually impacts overall business spending, I don't see that slowing down. So, I mean, if I think about what sector I'd want to be invested in and kind of have a little bit more peacefulness around some of these factors like Brexit and like the tariffs, I think technology and specifically software is the place to be right now.
That was D.A. Davidson's Rishi Jaluria. Sticking with tariffs, some are saying investors are looking to software as opposed to hardware as trade tensions escalate. IDC President Crawford Del Pret says tariffs are having less impact on IT spending than was originally projected. We spoke to him on Tuesday for more details.
tech spending actually hasn't been that significantly affected as a function of a lot of the tariff talk. A lot of that has to do with kind of where we were in the tech cycle. You have to remember that, tech is infused in the economy now. It's infused in our work lives, it's infused in the infrastructure, and it's also infused in how we entertain ourselves. So what we saw was that in a lot of markets, there was a huge data center build out, and server spending, storage spending was really, really high. If you look at infrastructure spending last year, it was over 20%. Now, if we had gone back 3 years and said we thought infrastructure spending would be over 20% as a function of the build out of the cloud, no one would have taken that seriously. So that really muted overall spending impact associated with the tariffs. So what we saw last year was about 9% growth overall, which is very high.
So where are we in that cycle now? As you look forward, let's say, to the rest of 2019 or 2020,
yeah.
Are we in that cycle where we can still start to see tech spending, or are we starting to see some uncertainty really start to play in?
Yeah, so Taylor, it's interesting. We're starting to see that shift now. We're starting to see where customers are starting to take a pause. They're starting to lock up a little bit and say, look, we can't run our business by these little bits of information that come out. We have to really understand and be able to understand the long-term impact of imposed tariffs going forward. So what we've seen is that we're starting to see a deceleration, and we're seeing a deceleration in spending overall. But it's primarily that we're seeing customers start to take a pause, but we're also starting to see that infrastructure build out is starting. Companies are starting to take a step back from that and starting to slow down their overall spending. So our expectation for spending this year is somewhere around about between 4 and 5% for overall tech spending.
When you talk about customers, there is hardware and there is software. And
right.
So far, it appears software for a little bit has been relatively insulated compared to hardware. Is that accurate?
Absolutely. So it's really interesting, and we have to kind of remember this as a service economy and what the long-term impact of the as a service economy is, and that is that it really becomes something that impacts are much more muted in terms of overall spending. Companies don't necessarily move away from their Salesforce.com subscription or their Workday subscription over time, but you can definitely say to your employees, you know what? We're going to make you have your PCs for 5 years instead of 4 years. We're going to push our server infrastructure out another year before we do an upgrade. So we're definitely seeing that hardware is the first stuff that gets muted. And really, smartphones is something that really gets muted because it's just not that hard for a consumer to say, you know what, I'm going to wait another year before I buy another smartphone.
That was Crawford Del Pret, president of IDC. Coming up, $170 million. That's what Google will have to pay as part of an agreement with the FTC for violating children's privacy on YouTube. But does that really make a dent for the tech behemoth? And if you like Bloomberg News, check us out on the radio. You can listen to us on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Apple is returning to the bond market after an absence of almost 2 years. It borrowed $7 billion. Apple's joining a slew of companies that are rushing to the investment grade market after the Labor Day holiday. The company has more than $200 billion in cash and securities on its books. Apple is developing in-screen fingerprint technology for its iPhones. Bloomberg has learned that the feature could be available in next year's phones. Apple's had fingerprint scanning since 2013, but it's integrated in the iPhone's home button. The new technology would allow users to scan fingerprints on a large portion of the display, and it would work with the current Face ID system. And another fine for Google. This time, YouTube has agreed to pay a record $170 million to settle claims that it violated children's privacy laws. Most of the money will go to the Federal Trade Commission. $34 million will go to New York State. YouTube has been accused of failing to obtain parental consent in collecting data on kids under 13. We spoke with Carl Szabo, Vice President of NetChoice, and Bloomberg Technology's Ben Brody on Wednesday to discuss. NetChoice is a tech lobbying group that counts Google as a member.
It's certainly easy for Google to pay it. It's a drop in the bucket compared to their annual revenue. It is, however, a very large fine by the standards of children's privacy. It's 30 times larger than the previous record, which came in February with TikTok. Similar issues, collecting email addresses and names without parental consent on the popular teen video app. So you have a lot of people who are saying that this isn't really going to make a dent in Google's business practices, but it is certainly setting a record for this particular space.
So, Carl, you're sort of taking the flip side of this. Give me your breakdown. What do you make of the fine and then, of course, of the ruling to limit some of the ads and the commenting on children's videos?
You know, thanks for asking. As Ben laid out, the fine is 30 times larger than any prior fine under COPPA. Now, what surprised me so much was the fact that the FTC was even able to extract this fine, given the fact that I think the FTC has gone well beyond the statutory limits of what the COPPA law allows. Essentially, YouTube is a general audience website. Every user on YouTube says that they're over the age of 13. The terms of service say if you're under the age of 13, don't use YouTube, you can't use YouTube. And so there's really no there for the FTC to bring this action. I think it sets a really dangerous precedent going forward by suggesting that a general audience website is now going to be decided by the FTC to be a child-directed website and subject to COPPA. I would say for anyone who operates a website talking about Harry Potter or the Avengers or anything that could possibly be related to children needs to be worried that the FTC may be coming for them next.
Well, Carl, to be fair, we've gotten a lot of pushback from some of members of Congress. We have a tweet, of course, from a senator, and I will read it out to you. Senator Ed Markey, who's saying that YouTube knowingly broke federal laws. They're tracking kids in order to rake in advertising dollars without permission from parents. But the FTC let Google off the hook with a drop in the bucket fine. Not a single Google executive or investor will bat an eye. Carl, what do you make of that? And frankly, the reaction from senators?
So Senator Markey should know very clearly what the law does and doesn't allow, since he helped write it when he was in Congress back in 1998. And under the law, there are two ways that you're subject to being under COPPA. You're a child-directed website, or you knowingly collect from people under the age of 13. YouTube did neither of these in this case. So I think for a lot of people who are saying it's not enough, I think for a lot of those individuals, it will never be enough. I think that for them, whether the fine was $170 million or $170 billion, it will never be enough for a lot of people who just fundamentally dislike these platforms and their right to give us free services.
As for all the antitrust issues surrounding Google and other technology giants, we caught up with former acting chairwoman of the FTC, Maureen Ohlhausen, Thursday, who weighed in on the issues at work.
The fine is only one part of the remedy in any of these cases, the Facebook case, the Google case. There are extensive provisions in the settlement orders that require Google to go above and beyond what the Children's Online Privacy Protection Act requires. So now they are having to screen content to see if it's child-directed, and to then go ahead and impose the parental notification and consent provisions on that kind of content. So I think that the fine is only one part of the equation. You really have to look at the conduct obligations that are being imposed going ahead.
And the U.S. led the charge in this particular respect. Do you think other geographies might look into the child part of the equation, whether there are any laws being broken or being perhaps not abided by in quite the way they would like in other parts of the world?
Well, I mean, it's certainly possible, and each country might have a different approach to children's privacy. The way Congress struck the balance in the Children's Online Privacy Protection Act is to have parents make the decision whether information about their children could be collected through online sites and services. in that way, what they're trying to balance is, incentives to create child-directed content against the, desire to make sure children are being protected. And that's the way we've struck the balance in the U.S. through Congress making that decision.
And clearly some lawmakers not always thrilled with how policies enacted by the FTC, as we heard from Cicilline. He mentioned perhaps a sweetheart deal for Facebook. That sweetheart deal was a $5 billion fine coming from the FTC, so a significant chunk of change, even though it pales in comparison to Facebook's overall revenue. But what did you make of that ruling on Facebook when it comes to privacy and how it changes the modes of conduct and the way that the business practices will unfold for the business going forward?
Well, the Facebook order, the settlement there is quite extensive, and it requires Facebook to create new types of oversight and monitoring and reporting, having obligations going up to the board level. It's quite extensive. And of course, a $5 billion fine dwarfs any other privacy fine that's been imposed really anywhere. So I wouldn't call it a sweetheart deal. I think it was a rather, strong message.
Do you think tech companies are in general getting the message that they, rather than having to respond to such accusations coming from regulators such as the FTC, they can in some parts start to get ahead of the curve and ensure that they're abiding by the letter of the law and the general meaning of the law before they're hounded by you, for example?
No, I think you're right about that. I think they are, paying even more attention to some of these issues. A lot of the companies have paid close attention to these issues, but I think it's really become a board level issue in a lot of companies, because there's not just the impact, from an investigation and a fine, whatever the fine may be, or what the obligations going forward are. There's also a reputational impact on these companies, and I think they care about that. But I also think it highlights the fact that the privacy laws that we have in the U.S., the Federal Trade Commission has done a good job with the law that it's been given, and Congress did pass the Children's Online Privacy Protection Act. But I think it is highlighting the desire to have maybe an additional federal privacy law that would give additional guidance to consumers and enforcers and industry itself.
Coming up, Slack slumps. Shares tumbled this week after the company disappointed with its first report as a public company. Why sales are slowing? Next. Plus, taking on Tesla, Porsche powers up its electric car, sports car, but will it be enough to charge past the Model 3? This is Bloomberg. Slack gave its first earnings report as a public company Wednesday, and investors were not impressed. While the company beat analyst expectations for both second quarter revenue and earnings, it projected slower sales growth for the second half of the year. Slack said revenue will be $154 million in the third quarter, signaling that strong competition may dent the software maker's rapid rise. We caught up with Bloomberg's Nico Grant and on the phone, along with Gartner Research Director Larry Cannell, on Wednesday, right after the results were announced.
It's pretty stiff competition, but what Microsoft is trying to do is push Microsoft Teams and this type of collaboration into the infrastructure. And so it becomes kind of this horizontal service that everyone in the company has access to. And we can tell you, based on our surveys in this past year, that Office 365 is increasingly being attributed to collaboration and enterprise collaboration, where in previous years it was more associated as an email outsourcing service. So, in my opinion, as Microsoft has succeeded with Teams, it's also succeeded in building awareness of the need for collaboration and the ability to collaborate more effectively in the cloud, which should indirectly help Slack and increase interest in the market overall.
I want to bring in Nico Grant. He's been covering Slack for us at Bloomberg Technology. So Nico, sort of give me your top takeaways here. What happened to the top line revenue growth?
Right, so Taylor, this is an instance in which Slack's best wasn't good enough. You know, we had seen for years that Slack was one of the most hyped unicorns in Silicon Valley. It raised at least $1.3 billion because of all of that anticipation, and the stock went down 15% today. The stock went down about 20% after that first pop when it went public in June, and the reason why is because the company is decelerating. And so whether we consider the revenue forecast for fiscal 2020, which was just short of the consensus estimate of Wall Street analysts, or if we consider the growth in the number of paid customers and large customers. But for many metrics, Slack is not growing as quickly as it once did. And of course, there's a law of gravity when it comes to these cloud applications companies. And the larger that you get, the more difficult it is to continue growing at the same rates. But Slack is a money-losing company. And so, from an investor perspective, if you're not making money, then you need to be growing. Well, and if you're not making money and you're not growing as quickly as we want you to, then we're a little bit concerned.
Well, you not only got the investor perspective, but you just got off the phone from the CEO. What did he have to say to defend top and bottom line growth?
Yeah, I just spoke on the phone with Stuart Butterfield, the CEO of Slack and co-founder, as well as the CFO. And Butterfield said basically, this is very strong growth for our business. The CFO echoed that sentiment. They said that when you consider the amount of customers who are spending more than $100,000 each year with Slack, so think of this as, the largest businesses in the world, that number increased by 75 to 720, but that's still a slower pace of growth, and they're very much looking forward to a current product that they have coming out right now, which they think can continue to improve things, but they're going to focus and tell investors on the earnings call, which has just started, about the customer stories, basically. Tell them, what companies are using Slack. They've seen lots of growth in Europe, including Germany. They're also seeing growth in the US, they say, but essentially they are sticking to their line of this is good enough, even as investors clearly are not happy right now.
Well, I want to bring in Larry back into this conversation because Larry talks sort of about the future of Slack, and part of that is bringing in some security tools. And I wonder, is that a future growth area for them? How does that compare with others?
Well, when you talk about Slack, you have to realize there's two different levels, different families of products. One is Slack Teams, which you may be familiar with. That's the free version of Slack, and it's a paid version of that where you buy it on a team-by-team or workspace-by-workspace basis. Then there's the Slack Enterprise Grid. That's the enterprise license product where you get all you can eat, all you can consume teams and workspaces. That's who I talk to our clients about most often. And that's where they're investing a lot into the security products as well. So they recently released a new desktop client, which handles more effectively a larger number of workspaces. So they're expecting some growth there. They're also building in some native mobile security features to kind of very similar to what Intune does with Microsoft, but to be able to control how the application behaves on a mobile device and to control the content that Slack uses on the device. That's all good stuff to help them compete and help them build credibilities with the IT professionals that I talk with.
That was Bloomberg's Nico Grant and Gartner Research Director Larry Cannell. And as a reminder, Bloomberg Beta, an early-stage venture fund backed by Bloomberg LP, is an investor in Slack. Still ahead, Porsche unveils its first electric vehicle. We'll run down the features of the Taycan, including, of course, the price. That's next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs, in for Emily Chang. Porsche is getting into electric cars. The automaker, famous for its 911 sports car, unveiled the all-electric Taycan Wednesday. The new vehicle will start at $90,000 with the top price nearly double that. Porsche's parent company, Volkswagen, is hoping this will help cement its ambition to be the world's leading seller of battery-powered vehicles. Bloomberg's Matt Miller caught up with Porsche CEO Oliver Blume to see what's under that Taycan's hood.
It is an exciting moment for us being able to present the new Taycan after a 4 years engineering period. And you're right, we have a lot of pre-orders, and in the last weeks it raised from 20,000 to nearly 30,000 pre-orders. And we are very proud of it because all these Porsche fans haven't already seen the car before the production and haven't already driven the car. So today we will mention what will happen in the market and what will be the response.
They trust your design language, they trust the dynamics of Porsche. What can you tell us about the financing though to build the car? I think you're the first car maker ever to develop a car with a promissory, at least partially with a promissory note, right? How did you come up with the idea? How did that work?
Yeah. When we did the calculation, electromobility, you have much higher material cost, you have all the investment you have to put in. And when we thought to calculate the product, we asked all the people in Porsche to help to be able to finance the project. And so everybody put a part of the increasing salary of the next years for being able to finance the project, beginning with the board members to all our people working in Porsche. And that was the first time in the automotive industry doing this. And at the end it was successful, being able to produce the car in Germany, in Stuttgart-Zuffenhausen, where the heart of Porsche is, where we produce the 911 and the 718.
Will you always make the car in Stuttgart, or will you always make the car in Germany? Is that something that your customers demand?
For our brand is very important. Having cars designed in Germany, engineered in Germany and built in Germany, it's a very important argument. And we thought to go to a new era with a full electric Porsche, we should do it where Porsche comes from Porsche Zuffenhausen, where we built the first 365, 56, and then the 911, and now the Taycan, and connecting our tradition with our future.
This will likely outsell the 911, and the starting price is about the same, right? $90,000, 90,000 euros. It's somewhere in the ballpark of a base 911. Do you have to sacrifice a lot of margin for that?
No, we will start first of all with our top-of-the-end projects with the Taycan Turbo S and the Taycan Turbo. And later on we will come with some base products which will begin a bit below 100,000 euros or dollars. And we have still a good margin. It isn't so high as in other projects we have, but we see the Taycan as a starting project for e-mobility, and there's a lot of potential in future for innovation, but also for economic scales.
Sticking with electric vehicles, startup FARADAY Future has named automotive veteran Carsten Breitfeld as its new CEO. Ahead of taking over the reins, Breitfeld spoke exclusively to Bloomberg's Ed Ludlow at the company's Los Angeles headquarters and outlined his priorities for FARADAY.
A $3-digit million amount is still missing to make all of this happen, I would say. And then in the next step, to scale the volume and to bring the next products to the market, the amount is even bigger. But if it is 100 or 200 or a billion, it's not so much of interest from my understanding. The most important thing is to get the trust of capital market and investors, that they really understand that this company has a great future. And if we can make this point, then we can progress. And this is where I see a bit of my value coming in here, because this company has a great vision. YT Jar developed a great vision. This company has great products. And what is missing now is execution. Bring the product to the market as fast as possible. And this is where I'm coming from. YT is very much coming from digital ecosystem, so he's covering this whole part. I'm coming from the car industry. I really know how to do cars, and I think this combination is perfect to really make it happen.
You said that's a good question when I asked you where the money was coming from. One of the biggest reported backers of this company, Faraday Future, was the Nine. There were reports that they had pledged something like $600 million to the company. To the best of your knowledge, how much of that money has Faraday Future received, and what is the status of that relationship with them?
I think strategically it's a very important relationship because this company is coming from the digital world, and we are talking about business models covering digital ecosystems. They are in the process of raising money now, and there are some agreements between Faraday and the Nine we are not able to disclose here, but I think we are on a quite good path to move forward together with them.
But as yet, they haven't contributed financially to Faraday Future.
This will be the next step now in the upcoming funding rounds.
That was Faraday Future CEO Karsten Breitfeld speaking exclusively to Bloomberg's Ed Ludlow. Coming up, a California bill is threatening to shake up the gig economy. How companies like Uber, Lyft, and DoorDash are responding next. Plus, WeWork is preparing for its public market debut. We'll discuss what this could mean for others in the co-working space. This is Bloomberg. It's been 2 years since Uber CEO DARA KHOSROWSHAHI took the reins of the ride-sharing company. Emily Chang spoke exclusively with him about the company's evolution under his leadership, as well as its future, including plans for an international expansion. Take a listen.
Part of our business has to fight for money. And if they're not deserving money, they're not going to get it. So believe me, internally, there's lots of creative destruction, there's lots of competition, and if one part of our business isn't carrying its own weight, we will pull back. Listen, we pulled back out of China, and we turned what was a $2 billion investment in cash into what can be a $10+ billion stake in Didi, which is a very big ride-sharing business in China as well. So we are, in the end, we're looking to build a business. We want to build a business the right way. We want to build a business in alignment with our driver partner society, et cetera. But if something's not working, we believe we've demonstrated the financial discipline to make the right call at the right time.
Driver protests are not unusual.
No.
When we last visited, there was a driver protest outside. Democratic presidential candidate Pete Buttigieg was out there with him. He said, "Gig is another word for jobs. That means you're a worker and you ought to be protected as a worker." There is support for legislation that would force companies like Uber that rely on contract drivers and delivery people to make them full-time. Why shouldn't they be full-time?
Because they don't want to be full-time.
Well, some do.
Some do. More than half of our drivers in the U.S., for example, drive less than 10 hours with us a week. And listen, right now California has a historic opportunity. We're at the table, we are having these discussions, and we want to get to a solution. We're offering $21 minimum an hour when you're driving on the platform. We're offering benefits, and we're offering a voice as far as how you're going to be treated going forward. It's $21 an hour compared to $12 an hour minimum wage. Okay, this is real money, and these are real rights, and you get the flexibility that every single Uber driver or courier wants because they can come into the market when they want to or out. This is a historic opportunity to, I think, revolutionize the gig economy, and I don't think gig is a type of work. To say that there's only one way to work and everyone needs to be full-time, etc., I don't think that's correct, because it takes away flexibility, and flexibility is absolutely something that all of our drivers prize.
And can you give them flexibility and give drivers and riders safety at the same time?
If the legislatures, works in the interest of making something happen, absolutely. And you know that we're making very significant investments in safety as far as the safety center, tracking your ride, etc. And we believe that we are the leader in safety as far as transportation goes in the world, and we'll continue to invest very aggressively there.
So, as the stock is down, drivers are picketing outside, the press is writing about helium balloons. How do you stay focused on the long term?
You put your head down and you work, and you know that this is a once-in-a-generation company that's going to change how people access opportunity and how people move. The work that we're doing is really important. Everyone is going to look at the short-term price. It's part of being a public company, and people have worked really, really hard, and the equity is a representation of their work. But I think the people here understand that if they keep innovating, if they keep working hard, the rewards will absolutely come. You can't control the timing, but you absolutely can control the outcome.
That was Emily Chang's exclusive conversation with DARA KHOSROWSHAHI. As KHOSROWSHAHI mentioned, he believes drivers should remain as contractors and has joined other gig economy companies to step up the fight. Uber, along with Lyft and DoorDash, pledged last week a combined $90 million ballot measure to ensure they don't reclassify their California workers as employees. California lawmakers have been weighing a bill, Assembly 5, which designates workers as employees if their work falls within the company's usual course of business. The bill is poised to go up to Governor Gavin Newsom this month if it clears the Senate. Bloomberg's Josh Idelson joined us to discuss.
We've seen these gig companies over the past year since the state Supreme Court ruling that set off this controversy, first trying to get relief from the governor, then from lawmakers, going and trying to reach a deal with union leaders that, with support from the legislature, if they had such a deal, could protect them from having to reclassify their drivers as employees. And companies are still trying to get a deal. They are still trying to get something to happen in the legislature that would mean they don't have to reclassify workers as employees, that would involve instead extending them other perks and benefits. But these companies see that that may not happen, and a bill, AB 5, that would codify and expand the application of the state Supreme Court ruling that the companies didn't like could instead become law and be signed by the governor. And so they are gearing up to be ready to go to the ballot in response.
Now, we've got statements from three of these companies. Uber saying our proposal would dramatically improve the status quo and we think protect the flexibility that is both core to Uber's value proposition for drivers and ensures a dependable service for riders. Lyft saying we remain focused on reaching a deal and are confident about bringing this issue to voters if necessary. And meantime, this from DoorDash. We're fully committed to a legislative solution that would protect the rights of workers who are choosing the flexibility and independence of working as an independent contractor and to provide historic new benefits and protections to them. You know, tell us a little bit more about what's at stake here. You talk to drivers, you talk to delivery people. The vast majority of them do not think that they're getting paid enough, but do they really want to be full-time?
You hear all kinds of things from people, and the truth is being full-time or part-time is not the same distinction as being an employee or a contractor under the law. There are various people who are part-time employees, but more broadly, there is this trend in the U.S. towards what some call the fissuring of employment, that more and more people are creating wealth for a company that sets rules for them without being considered that company's employees. And that business model is at stake here. California, besides being the home of many of these companies, is a crucial market and also a bellwether that will be looked to as presidential candidates and others debate what should happen in the gig economy, and should there be accommodation of these new models? Should some of these models have to adjust to accommodate existing laws or new laws to extend some of the protections that historically have been tied to a particular definition of employment? And so we've seen 2020 presidential candidates weighing in on this legislation. We've seen these companies in SEC filings reference the threat that they could have to make a major change to their business model if they're not able to get the kind of compromise that they're looking for.
What does this mean beyond California?
Well, already the week after the court ruling that set off this controversy, Bernie Sanders last year introduced a bill that would apply a similar test to federal labor law, again, making it so that if you're not doing business, if you're not doing work outside the usual course of a company's business, then you're not an independent contractor. And so if these companies are able to say that California itself backed away from and changed that test, then that will be a useful talking point for them in discussing whether that should happen at the federal level or in other states.
That was Bloomberg's Josh Idelson. And for the second time in under a month, Google hacking and research teams revealed what happens on your iPhone doesn't always stay on your iPhone. Basically, visiting a small number of websites could have left iPhone users susceptible to the breach. That could have possibly affected thousands of users per week. We should note that Google let Apple know of this months ago, and Apple updated its operating system less than a week later. So it's apparently been fixed, but Google has only now revealed the vulnerability existed at all. We spoke with Roy Carmel, Chief Strategy Officer in Cyber Reason, and Bloomberg cybersecurity reporter Kartikeya Mehrotra last Friday to discuss.
What happened here was what we call a zero-day vulnerability, where vulnerability exists and hackers are aware of that vulnerability before any patch exists to close it. And that vulnerability opened up the iPhone platform for any attack through malicious website. Just by surfing to the website through Safari, a malicious malware could be downloaded to the device and gain access, which could be escalated to have full access to the whole device. And malwares like this could then get access to iMessages, photos, locations, and can do all sorts of damage, all the way from deleting data, extorting the user, as well as running a full espionage attack, similar to what we saw in Soft Cell about a month ago. Going from the telco side, we now see that possibility going from the device itself.
Now, Kartikeya, it's interesting that Google told Apple about this privately. They had time to patch it, but then still made it public and embarrassed them, which does not seem so white hat. What's your take on this?
I mean, what's interesting about this one, and what we always ask about when these attacks occur, is can anything be left behind? Is there malware that can be left behind? And in this attack, it seems like that possibility certainly exists, which is concerning for users, and for users to understand that no matter which device they're using, there are going to be vulnerabilities. There are going to be places where they may not be necessarily safe going into, and to be smart about where they're using their devices and how they're getting access.
Roy, do you believe there's something disingenuous about Apple's privacy marketing and, you know, the billboard saying what happens on your iPhone stays on your iPhone, when they can't guarantee that?
So I think, as an approach, Apple has taken an approach of keeping a close and fully integrated technology stack, which did help them to protect the platform. But it's also fair to say that no platform is fully safe. And we live in a world where we need to be in a post-breach mindset. We need to assume that if a processing unit exists, it's hackable, and it can be breached and has vulnerabilities. And I think only with that kind of a mindset we can really protect ourselves.
That was Bloomberg's Kartikeya Mehrotra and Roy Carmel of Cyber Reason. Still ahead, WeWork's readying for an IPO, considering seeking a valuation of about $20 to $30 billion. Bloomberg learned that this week. We catch up with the competitor in the space, RIVETER, next. This is Bloomberg. WeWork may seek a valuation of up to $30 billion in its IPO. Bloomberg has learned that the office rental startup is still discussing potential terms. Earlier this year, an investment from SoftBank valued WeWork at $47 billion. One investor, billionaire Sam Zell, is not a fan.
The worst part about it is the corporate governance. The corporate governance is unconscionable. And the idea that JP Morgan is putting out an IPO with that kind of corporate governance is just unacceptable and is very negative for our whole economic system.
WeWork may kick off its Investors Roadshow next week. But it's not the only company disrupting the co-working space. A WeWork competitor, the RIVETER, has opened 10 community workspaces across the U.S. designed to accommodate women specifically. Since 2017, the company has raised $21.6 million with the goal of advancing workplace diversity. The RIVETER CEO and founder Amy Nelson joined us on Tuesday.
So WeWork is obviously a giant in the industry, but the RIVETER sees itself as standing somewhere else. We are more like a modern-day union for working women. We have content, co-working, and community, and we provide a number of different price levels and access points for our members. So we cater to a demographic that needs truly flexible work. They might need a part-time membership or to drop in hour to hour. And then we also look at how we can advance our community in the workplace. We do that through innovative programming like office hours with venture capital investors, as well as exciting programming with celebrities coming in from Maria Shriver to Arlen Hamilton.
Amy, how do you take advantage of some of the negative recent press around WeWork, namely about their financials, overvalued, high liability, lack of profitability? How can you use that to your advantage?
So we don't try to use it to our advantage, but I do think it's really instructive to us to look at how other companies that are going public are showing us their financial growth. A venture-backed company's job is to take money and use it to fuel its growth, and so I don't fault WeWork for doing that at all. I think the interesting moment that WeWork has right now is to think about how they can change the direction as they go public and the statements that they can make. I mean, one thing to note, right, they don't have any women on their board right now, and I think it's an incredible opportunity for WeWork as they go public to make their board half women. They have so many incredible women leaders in the company, and so why not bring them into a more public position?
How do you differentiate yourself financially? You have rival companies that lease instead of own out their properties. How are you built basically from the bottom line?
Absolutely. So our model, we look at it as real estate light. So we are not going and engaging in massive build outs. Because we're catering to a demographic that wants more flexible workspace, the RIVETER is able to go into buildings as they are, kind of mold them into what our brand is without doing a large build out. This allows us to take shorter leases with options to renew, and our build out costs are much lower, and we aren't amortizing them over the life of the lease.
Are you profitable?
All of our spaces are cash flow positive, which is a big, it's a big moment for us.
Do you view competitors like WeWork as a zero-sum game? Or do you think that if they succeed and highlight the success of co-working environments, that everyone can succeed in that space?
I think that co-working is an industry that is just beginning. I think that as the future of work changes to be more flexible, that freelancers and people working in the remote economy and the gig economy will need spaces like this. I like to think of our spaces and how we can cater to really interesting segments in the economy, like working mothers who might have left full-time jobs but have gone on to do independent work on their own. And so we provide spaces for that demographic, which is really exciting. And I think that there is enormous opportunity for so many players in this space.
We talk about WeWork, of course, trying to file for their public offering and looking at going public in the coming weeks, coming months. Any plans for your company to go public?
Not today. We are just 26 months old, so we're very new. But down the line, I think anything could happen.
That was the RIVETER CEO and founder, Amy Nelson. That does it for this edition of the Best of Bloomberg Technology. We'll bring you all the latest in tech throughout the week. Tune in each day, 5 p.m. New York, 2 p.m. San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.